Hi guys, would you be interested in a trading approach where the moves can be really big? You know, sometimes Euro USD can move like between 500 and 1000 pips and maybe even more, and gold can move like 100, 150, $200. If this is something that resonates with you, then this video is definitely for you. First of all, please do remember that we don't provide any investment advice, and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Let's talk about trend trading, or trend following as it's also known. When you're looking to participate in trends, you really need to be able to do two things. First of all, you have to be able to recognize the market reversals, and secondly, you need to know when the market is more likely to continue to trend than reverse. In this video, I'll introduce you to key technical tools that help you to do this. So I'm going to cover technical tools like market reversals, higher or lower swing highs, market structure, breakouts, loss of momentum candles, and moving average momentum. Now, before we go any deeper into this topic, let me just briefly cover the theoretical basis here. So, institutional buying or selling both initiates and maintains price trends. In uptrends, market participants drive the price higher by bringing more capital inflows to the market, and conversely, in downtrends, they drive the prices lower by selling the market. So, capital outflows from a market as well as short selling pushes the price lower. And this is why you and I as small retail traders should never ever try to fight the markets. We just don't have deep enough pockets to fight the institutional investors. So trend trading is really about recognizing market reversals and trends and then taking advantage of them. So let me give you some tools for this. Here I have a Euro USD weekly chart, and as you can see, the market was moving higher, it was trending higher for quite a while, and then came a reversal in the trend. And this reversal resulted in a 2000 plus pips down move here. So this trend was quite long and well sustained. So we have two options for initiating a trend following position here. Either we can wait until the trend is established so that we have here the fast moving average below the slow, or we can anticipate the trend reversal and then, based on price action, sell near the top. Let me give you some examples on how to do this. So we really have two options on initiating a trend following position. We can either wait until there is an established trend. So we have, for instance, the fast moving average, the red one here, below the blue, and the price is making lower lows. Or alternatively, we can look at the market up here and read the price action and use the tools that I'm going to give you soon. And then we can probably manage to sell at the top and have a better profit margin for our trade. On the left hand side, we have the weekly chart at the time of market creating a lower swing high here. So that's the big picture. And then on the right hand side, we have an 8-hour chart that gives us a more detailed picture what's happening in the price. And here we come to those tools that I mentioned earlier. First of all, look at the SMA, a momentum loss. The fast moving average is approaching the blue, so the distance between them is getting narrower and narrower. So there is definitely momentum loss. But more importantly, we have a break of structure here. The market breaks this support, then rallies a bit, creates a lower swing high, highly important, and then we have another break of structure. So this is a classic example of market reversal taking place. It might not be that evident here in the weekly chart, but in the 8-hour chart we can clearly see market giving us clear indications that the trend is going to reverse.
what we have here is a loss of momentum candle. So that's the weekly, the bigger picture signal that we can obviously, and we need to obviously pay attention to. But then we can go, once we see this, we can go into the smaller time frame chart and see that yes, we have clear indication here that the market might be actually reversing. And then there's another lower high, and you can see these exhaustion candles or momentum loss candles, and it's never one single item or one single factor that creates the market reversal, but it's the combination of all of these things. You have the momentum loss candles, you have the break of structure, you have the momentum loss in the moving averages, and also, let's go to the previous image, we have a lower high in the 8-hour chart. So all of these factors together tell us that it's highly unlikely for the market to continue higher. So therefore, it's more likely that the market is actually reversing and moving lower. Okay, now we have covered the market reversal from an uptrend to downtrend, and we have seen the tools that can be used in recognizing these reversals. But what about those trend continuations? Let's take a look at those. The red dotted line here represents the point where the fast moving average starts to move below the slow moving average. So we have a bearish crossover there. And the idea is that now the trend to the downside is established, and we're looking for reasons to go short in the 8-hour chart. Obviously, when there's momentum to the upside, it really doesn't make sense to go short. So I would like to challenge you now, because you have seen some of those technical tools that I just gave you. Try to identify, using those tools, where you should be looking for short entries in this 8-hour chart. Okay, now I will give you my answer. Let's take a look. Here's my answer. So basically, it doesn't make sense to go short in the market. Even if the weekly is down, there can be uptrends in the daily and 8-hour chart. So when you see this in the 8-hour chart, it really doesn't make sense to go short. We want to have evidence for our short position, or evidence for our short thesis, I should say. And when we have a couple of things coming together, lower swing high there, and then we have the trend failure when the market moves outside of this bullish trend channel, and we have the break of structure here. The market closes below the neckline there. Then we have evidence in the weekly chart that the market might be weak, and then we have evidence that in the 8-hour chart that the market indeed is getting weak. So that's when it makes sense to look for short entries. That's a potential short entry here at 1850, and the market moves to about 1860 before it starts to move lower and moves down about 50 pips in the first push. But remember, this is not an opportunity to make 50 pips. This is an opportunity to get into a trend following position that has potential to make hundreds of pips, or maybe even as much as 2000 pips, like in this case. And what's more, you can add to these positions each time the market creates new opportunities. And when you're in a downtrend, it keeps on creating lower swing highs. It keeps on creating lower lows, and it keeps on breaking structure. So when the market is trending lower, these opportunities come one after the other. That's the definition of downtrend, really. If there is no sequence of lower lows and lower highs, the market isn't trending down. And the very fact that the market does this creates these opportunities for you. So keep on looking for these signs of weakness in the market. Now, there's one thing I want to point out. Please don't trade too big, because we're trying to catch big moves. you can trade small size and keep on adding to the position. The problem comes in trend following when you try to take a move like this. Let's say that you focus on this break of structure and you short the market on the break below the support. Now, the market can move something like 50 pips against you. And okay, it's not huge, but if your position size is too big, relevant or relative to your account size, you might not be able to handle this. So I'm just giving you a friendly warning here that you better trade small. And then you can add to your position when the market moves in your favor. So let's say that you initiate your position. The first short entry comes at 1850 or so. Then the next one comes at 1797, and the third one at roughly 1762. It means that each time you enter a trade, you have more and more buffer behind you. You have more and more open profit so that you, in a sense, you're playing with the market's money. And if you keep on doing this, by the time the market moves further away, and like in this occasion it did, you can have a substantial position on benefiting from this market, and you can still keep the cost level relatively high. So if your cost base is high, then and you keep on adding small size on the way down, then you are safe, even if the market occasionally rallies against you. Okay, let's take another example, this time with gold and on the long side. So the market had been trending lower for quite some time, actually from August 2020 to about April 2021. So after several months of trading lower, gold reversed quite sharply to the upside. So what was the reason for this, or what can we read in the price action that alerts us to moves like this? Let's go and take a look. Here in the weekly chart, you can see how the market created double bottom and there's a loss of momentum candle. So this is a significant signal that the bears aren't in the control anymore and the bulls might be actually pushing the market higher. Then in the 8-hour chart, we can see that the market creates a higher swing low and then there's a break of structure. So a breakout above a sort of key resistance level. So here is our long signal. And just like with this Euro USD example, you don't want to put yourself in a position where you are a weak holder. So if your position is too big, you are forced to put the stop fairly close to your entry level. But if you have a small position, then you can have the stop further away and you can give the market some breathing space. Because we're not trying to make money with a small quick move. We are trying to catch the big move that makes the big money for us. And remember, the market can move against you, even though the big trend is pointing to the upside. And sometimes it does. It might come back to your entry level, or it might come actually even further and dip below your entry. And you never know how far it goes. So the farther away the stop is from your entry level or from your entry price, the better it is for you. Because at the end of the day, we're just trying to get on board to have the big move and then to have the opportunity to add into this big move later on. And just like with this Euro USD example where we took a short each time the market broke structure to the downside, now we do the opposite. As the gold moves higher, breaks structure to the upside, there is an opportunity to go long. And if we add a little bit each time the market moves into new highs, we keep the cost base low enough so that we are actually playing with the market money. We have the buffer, we have the profit, open profit that helps us to stay in the trade, and so we can move higher as the market keeps on moving higher, and then exit when there is no more momentum and the market starts to reverse to the downside.
Thank you for watching, guys. I hope you liked the stuff. If you really liked the video, give us thumbs up, and also maybe you can share this with your friends and subscribe to the channel too. So until I find new material for you, I wish you safe trading, happy trading, and I see you soon on the next video. Take care.